there, welcome to The Trade. Let's get across what's moving international markets and what traders are watching. The US dollar gaining against major currencies following that better than expected retail sales data in the US that showed underlying economic momentum. Of course, markets bracing for the Federal Reserve's move as well as the ECB. Investors in Asia entering a crucial 24-hour period in a cautious mood. Stocks in the red, risk appetite subdued, ahead of not just the Fed, but also, don't forget, the Bank of Japan. Oil eased about 1% to a one-week low overnight. Demand worries following that negative economic news from Germany and China. And gold slipped under pressure from that strengthening US dollar. And as Treasury yields climbed, with that focus remaining on the Fed. Copper has also dropped to a two-week low, so worries about China remain. So let's get into the technicals, what he's watching. Chris Weston from Pepperstone joins me now. Chris, welcome. Interesting moves in Treasury. So what do you think that's telling us?
Well, I think there's a mixture of some modest inflation expectations. We've seen some slight rise in term premium as well, which feed into sort of the nominal yield. But I think most of this has been driven by sort of better growth and a slight repricing of interest rate expectations that have been coming through. More is the most sort of biggest driver. But yeah, I mean, I think that people are watching the 10-year Treasury very closely. We're trading at 4.38 at the moment, 4.38% at the moment. I think the recent highs of 4.50 are obviously really, really important. Whether we can get there, I'm sceptical. We didn't see much of a reaction to the retail sales numbers, which on the advanced reading was a little bit hotter. But last week was a huge move. I mean, there was a huge sell-off playing through in the 10-year Treasury, up 24 basis points on 1 week, which is a very, very punchy move. Not necessarily justified by the CPI numbers and the PPI numbers. So, yeah, I think going into this week, there was a sort of a big issue is would we continue to sell off and get high yields? And, can we break through that recent pivot of, 450? I think the market's pretty happy the equity market and risk assets are pretty happy to absorb higher long-end Treasury yields as long as it's driven by better growth. If we were to see in early next year, a situation where long-end yields rise and we do see a steepening of the curve, and it's driven by more sort of right tail risks, i.e. inflation, with some cooling in labour markets and lower growth, then that sort of stagflationary environment with higher yields, I think, would be a very, very toxic mix for markets. And that's why in the sort of the first chart with the Treasury markets, I can't actually see at the moment, but I think that was something that we do need to keep an eye on. I don't necessarily think it's going to happen, but if it was to happen and we got a break of 450 and it looks like we're going to go into 5%, I think that those higher Treasury yields for next year, if it was to happen, and the rate of change is obviously really important, I think that's something that could cause significant drawdown in equity markets as the discount rate lowers present value. So, I think the 10-year Treasury has to be on everyone's radar for next year. Obviously the risk is if we get inflation expectations rising and that lifts Treasury yields, then that would be a significant risk for markets going forward. But we're not a million miles away from big levels here.
Mm-hmm. Okay, so that's on the radar. And obviously, what we hear from the Fed and the FOMC tonight will go a long way to helping determine in the short term where they go, but also where the US dollar heads. And I mean, Aussie dollar, it's got to be at crucial levels, Chris. I mean, what happens if we fall any lower than we have already hit, which is the lowest of the year?
Yeah, we're sort of going into the lowest November 2023 at the moment. I mean, it's a tough one, isn't it? Because positioning obviously starts playing into this, and there's a market is now getting progressively running a sizable short position on the Aussie dollar, as they are with the Kiwi dollar as well, and it's more sort of a risk play than anything else. But I don't think it's just the Aussie, Nadine. I mean, going to look at some of the other sort of high beta plays. The Brazilian real, obviously it's had some domestic issues and other factors, but that's at all-time lows at the moment. The Chilean peso, another sort of commodity currencies at all-time lows against the US dollar. So there's been a big sort of EM and LATAM FX play to be short, and obviously had a really strong year last year as everyone stockpiled into carry positions. But I think this is also thematic that rate expectations on a relative basis have been coming out in Australia. I mean, we go back to September, there was, forward rate 2-year rates in Australia are about 20, 30 basis points higher than they were in the US. And we've seen about a 70 basis point drop in Aussie expectation relative rates relative to US over the next 2 years. So certainly, expectations of RBA action has really helped, lower the Australian dollar to down to the current levels that we are at the moment. Not just a strong US dollar play, but there's been a relative rate setting position. Difference in two-year Aussie government bonds relative to US government bonds have been falling, and that yield advantage has been coming out. Relative terms of trade in Australia have been falling relative to the US. There's a whole plethora of reasons as to why we can justify the trend that we've been seeing down to these current levels. Rallies are to be sold, in my opinion. I think any kind of strength suggests that I would be selling Aussie dollar in this environment. But I also believe, that we are going to come into a higher volatility regime in markets in Q1. And I think if we were to see a bit more of the VIX trading into 20% plus, higher equity and FX volatility, and gold moving a little bit higher, and certainly gold options implied volatility moving up, I think the Aussie dollar could get a new low because of that dynamic. I mean, the Australian dollar has been falling in a very positive risk environment. So what happens if we were to see higher volatility and the US dollar coming in more of a safe haven play? That's something we need to look at. But right now, it's pretty ugly out there. It takes a brave soul to be piling into the Australian dollar at these current levels, given where we are. But I guess the other factor, of course, is what did the RBA do in the February meeting? The market's now implying a 60% chance that we get a 25 basis point cut. I still think that we should be closer towards 35, 40%. So maybe there's a little bit of upside from that perspective.
That's a pretty scary looking chart for the Aussie. You alluded to volatility. I know you brought a chart for the VIX index. We saw it lift overnight, but generally speaking, Chris, I think it's safe to say that it's been under historical averages through 2024. Everybody wants to know if volatility will increase from here. What are the charts telling us?
Well, the chart that I've got here is actually the 15 years of blended returns into one. So effectively, you can see that the sort of a seasonal performance is a way of looking at the seasonality of the performance of the VIX, which of course looks at the implied volatility, 30-day implied volatility of the S&P. So you can see here that historically, seasonality, that Q1 is a good time to be long volatility. And S&P volatility does increase by about 5 or 6 volatilities through that period. Now, I think that the interesting point here is that if we go into the new year, that there's a whole number of reasons to believe that we will see higher volatility in line with that seasonal factors. I mean, you're right. Volatility in US equity markets has been low. Obviously, we had that period in early August where the VIX spiked up to 65% and the VIX futures up to 38% or so. But it was very short-lived, and that sort of 9% drawdown only lasted 14 days before everyone started piling back into it. And I think we've only seen 3 days in the S&P this year where we've seen 2% plus declines on the day, which is unbelievable. But generally speaking, the VIX has averaged this year 15% relative to the long run or the 5-year average about 21.3. So it has been a lower volatility regime, and you can see that on a cross asset basis on the MOVE index in Treasuries, and FX vols have been pretty low up until recently. So it has been a period of low volatility. Now, I guess one thing that makes me interested here is that we've got the seasonal factors there. We're going into a period of trade tariffs from January the 20th. And, whilst I think what happens behind closed doors could actually look remarkably different from what was going to be seen on the headlines, the market is going to expect to see some pretty punchy and pretty pointy tariff negotiations. And Donald Trump obviously is going to need to make sure that he goes back to the voting public, making him look like he's the winner, and that he's fighting for the voters' prospects against China and Canada and Mexico and every other country that's getting tariffs. But it could be superficial, but it's going to make life pretty lively. Look at valuations on the S&P after the extent of the 28% move we've seen on the S&P. We're at multi-year highs in valuations. The equity risk premiums at the lowest since 2002, and positioning in the S&P is multi-year highs as well. So there's really no cushion for error or to get any kind of negative news playing through. So from that perspective, it does sort of lead us to a higher probability of higher volatility playing through as well. that seasonal factors there. So I think all of these factors suggest to me, with the poor market breadth we're seeing in the S&P, that we could see higher volatility through Q1. Of course, that is really, really, really important for any trader, because higher volatility changes the liquidity in the underlying, which can lead to wider bid-offer spreads, which change the cost of trade. It can change our hold times, the duration of positions, the frequency of positions, the strategies we employ in different volatility. So for me, volatility is the most important aspect, consideration for trading. And all the probabilities are suggesting that we are going to get high volatility in Q1 here.
Traders love volatility, plenty of opportunity. Yeah. Chris Weston, Pepperstone, always good to see you. If I don't before the break, I'm wishing you and your family a healthy and happy holiday.
I think you will. But,
okay, all right, looking forward to it.
And you,
what?
And you too, anyway. Thanks, indeed.
Thanks, see ya. That's the trade. Be sure to join us tomorrow, but don't go anywhere. Plenty more to come.